Okay, let's talk about the 2008 financial crisis. We all remember it, right? The story we were told was that the Federal Reserve pulled out all the stops with a historic stimulus to save the economy. But what if that story is wrong? What if the very policy meant to be the cure actually made the disease worse?
Right. So the common view is that the Fed unleashed the most aggressive, easy money policy we'd ever seen. But this research paper asks a pretty radical question. What if they were looking at the wrong dashboard? What if, completely by accident, their stimulus was actually hitting the brakes on the economy?
And this slide, this frames the whole puzzle perfectly. On one side, you've got the common view. Interest rates were pushed to zero. I mean, you can't get much looser than that, right? But on the other side, this paper says we should have been looking at the actual quantity of money in the economy. And that, well, that tells a completely different and, frankly, a much more alarming story.
So you might be wondering, how did we end up focusing only on interest rates in the first place? For decades, that's been the main tool in every central banker's playbook.
Well, you can kind of see how it happened over time. Back in the 80s and 90s, economists started losing faith in the money supply numbers. They just seemed messy, unreliable. And then some really big studies came out that seemed to confirm it, that the link between money and the economy was getting weaker. So policymakers shifted their focus to something that felt more direct, more controllable, interest rates. And pretty soon, the money supply was basically left out of the conversation entirely.
But here's the twist. The authors of this paper argue that maybe the problem was never the idea of money. Maybe the problem was just how we were measuring it. This is the absolute key to the whole thing. Okay, so the standard method is called simple sum. And it's exactly what it sounds like. It just adds everything up. $1 you can spend right now from your checking account is treated exactly the same as $1 tied up in some investment fund. It's like making a fruit salad and saying a grape, an apple, and a watermelon are all just one fruit. Simple? Sure, but not very accurate. So this paper champions a much smarter way to do it, called divisia. Instead of treating all money the same, it gives more weight to the money you can actually spend easily. So back in our fruit salad, the easy-to-eat grape counts differently than the watermelon you have to slice up. It gives you a much more realistic picture of what's actually available.
And this is the perfect way to think about it. Using the simple sum method is like trying to understand the economy by looking at a blurry, out-of-focus photo. Divisia is like switching to a crystal clear, high-definition picture. You're suddenly seeing details you never knew were there.
So what happens when you go back and redo all those old economic studies, but this time you swap out the blurry photo for the HD one? Well, let's just say the entire story gets flipped on its head.
It turns out, when the researchers used this sharper divisia data, that broken link between money and the economy suddenly reappeared. It was strong all along. It turns out we just weren't measuring it right. In fact, the models that include this better measure of money work so well that they blow the interest rate-only models right out of the water. Okay, now let's take this new high-definition lens and point it directly at the 2008 crisis. This is where it gets really, really interesting.
So remember, everybody was watching the federal funds rate. And as you can see, the Fed slammed on the accelerator, pushing that rate all the way down to zero. To everyone watching, this was the very definition of easy money. The floodgates were open.
But here's the divisa chart, the high-def picture. While interest rates were on the floor, the actual, properly measured supply of spendable money wasn't just slowing down. For a critical period, it was actively shrinking. The economy was literally being starved of cash right when it needed it most.
And that leads to this jaw-dropping conclusion from the paper. They argued that the policy everyone saw as a massive stimulus was, in reality, overly restrictive. And it didn't just happen. It actually helped make the Great Recession longer and deeper than it ever needed to be.
So what's the big lesson here? Why does a debate about how to measure money actually matter to us in the real world?
Well, it means our central bankers might be flying blind. They think they're flooring the accelerator, trying to get the economy to speed up, but a more accurate gauge would show them they're actually pumping the brakes. They're misreading the situation in real time, with huge consequences for all of us.
This whole thing also makes you look at quantitative easing, or QE, in a completely different way. You know, that policy where the Fed bought up tons of assets. See, this research suggests QE wasn't some crazy newfangled experiment. It was actually a return to basics. When your interest rate lever is already stuck at zero, what else can you do? You have to focus directly on the quantity of money in the system. So QE was just the Fed, maybe without even fully realizing it, rediscovering that old, forgotten rule.
And that leaves us with one last, pretty unsettling thought. If a simple measurement error could have made the worst economic crisis of our generation even worse, it really makes you wonder, doesn't it? What other big economic truths that we all take for granted are actually just measurement errors in disguise? And what's the real cost of getting it wrong?